Assalamualaikum and hi everyone. Welcome to Principal Malaysia's 2023 Quarter 1 Market Outlook. I'm Azita Baizura and I will be your moderator. With us today we have Mr. Patrick Chang, CIO of Principal Malaysia and CIO Equities Principal Southeast Asia, Mr. Jesse Liu, CIO Fixed Income Principal Southeast Asia, and Mr. Lee Chun Hong, Head of Equities Principal Malaysia. And with that, let's kickstart our Quarter 1 Market Outlook. Patrick, 2022 charted a very volatile year with a confluence of factors being priced in such as higher inflation, rising interest rates, and geopolitical risk. How can you summarize the equity market performance in 2022 and what are the expectations for 2023?
Yeah, very good questions. In one word, surprise. So I was very surprised by, like you said, the fact that inflation was very high. And the fact that the Fed was basically very aggressive in raising interest rates. I was also very surprised the fact that geopolitical tensions got to where we are today. It is really not over yet, and hopefully things will start to simmer down a little bit. And I was also very surprised at the fact that markets were as volatile as they were, right? Given what we have known today and the way I think markets have behaved in 2022, I think 2023 looks like it could be a better year, but I think the underlying message that I want to tell clients out there is that I do believe that things are still going to be fairly volatile, and therefore we need to think about how we want to diversify our assets in a very more uncertain environment that we're still in today.
Okay, thank you, Patrick. And for Jesse, how do you look for fixed income market?
I think similarly to what Patrick mentioned, it's a surprise, but it's a surprise in a different way. I think when we were back in 2021, there was some degree of inflation expectations, but when inflation really kicked in 2022, it was relatively higher than most of what everyone had expected it to be. And that adjustment had to be made on a central bank level because of that inflation data that has been more aggressive than what was anticipated. And because of that, you saw fixed income markets start to correct. But more importantly, I think there are degrees of differences between different economies. So countries like in the US, in the Eurozone, in UK, you would have a bigger adjustment in the central bank levels. And therefore, it created a much more volatile fixed income market over there. You would see performance for bonds denominated in those currencies to be relatively high in the teens or mid-teens today. But if you look at other parts of the country, of the world, for example, in ASEAN, where central banks are not as aggressive because the inflation is pretty much partly subsidized by fiscal policy, you would see that the reaction function of the central bank is much lower. And because of that, bond markets in local currency, Asian region has performed fairly well. So at one side, we look at developed countries having double-digit mid-teens kind of performance, negative performance. In our world, we are looking at more single-digit. In Malaysia, we are looking at more a neutral kind of performance in terms of 2022. Moving to 2023, to your question, I think it's important to note where central banks are going to go. And we do think that they will probably be less aggressive as compared to 2022, and that actually should be better for them in their markets.
Thanks, Jesse. Now, back to you, Patrick. Interest rates, despite the aggressive hikes so far, is expected to slow down in 2023, while the overall magnitude is still expected to lead to a further weakness in the economy and potential contraction in corporate earnings. So how do you think you're looking at equity portfolio, particularly those with growth attributes? Do you foresee further volatility in the first quarter of 2023?
Yeah, like I said earlier on, volatility is here to stay. But I don't think that investors out there should actually ignore growth companies. In our portfolios, we continue to invest in quality growth companies, right? Whether it is in Asia Pac, China, ASEAN, Malaysia, and so forth, right? So we continue to look for that. I think quality is the name of the game today. And what we're looking at today is growth companies, particularly where there are long-term structural plays, for example, like renewables. We also like, for example, tourism plays across ASEAN, for example, and the likes of the other more structural plays in certain technology companies across Asia. So I don't think investors should ignore growth, despite the fact that we've got the big R word called recession coming on board. By the way, it's not really a given yet, but probability is really rising. So I do think that investors need to think about, if you still have an appetite for risk, growth assets, in particularly our portfolios itself, will continue to give you that kind of exposure.
Okay. And back to you, Jesse. We saw fixed income in general continue to swing between pessimism and optimism over the potential for dovish pivot from the Federal Reserve. What is your view on the movement of yield curve in the global front as well as our domestic bond market?
Okay. So if we look into the US, the yield curve has already inverted, meaning that the short end of the curve has a higher yield compared to the long end of the curve. And this is a typical structure whenever you have a rising interest rate environment, and especially when it is about to peak. So it's not surprising to see that yield curve being inverted at this point in time. The key question is when this inversion would actually change. Now, typically, it would start to move, normalize, means that inversion will correct when you have a rate cutting cycle. At this point in time, I think where the Fed is focused at is inflation. And if inflation continues to be elevated, I think the Fed might choose to maintain a restrictive monetary policy. Means that if they hike up to, for example, 5.25% thereabouts, and inflation continues to be high, they might maintain that. If they maintain that policy around there to be restrictive in order to bring inflation down, then we would expect yield curve to maintain its inversion and then not change in the foreseeable future. So the only thing that we think, the only event where we think that it would result in that correction is when inflation starts to subside and a recession, like Patrick said, sets in. Then we would expect the Fed to start cutting rates, and that will cure the inversion.
Okay, thanks, Jesse. And now moving on to Chun Hong. What sort of key policies can you expect from the new administration to revive confidence and FDI?
Okay, thanks, Azita, for the question. So yes, finally the G15 is over, and yes, this is a date that everyone been guessing for the past couple of years. But you're just looking at the manifesto by the three key coalition. All of them are pointing to one key things. They seem to be pragmatic, and they focus more on the livelihood of the rakyat. So hopefully that's the case, because we are just exiting COVID-19 lockdown not too long ago, and like what Patrick and Jesse say, potential big R or recession coming on the global economic outlook. So it's wise and rational for the government policy to be focusing on how to revive the economy of the Malaysia. So nonetheless, with the election is over, hopefully the government will be stable compared to a couple of years ago. And with that, we should be able to revive the confidence and start to see FDI flowing back to Malaysia, because as you know, Malaysia has the best infrastructure in the region, and also is strategically located in the region as well. We have one of the best port in the world, and also we have a pool of talent in Malaysia as well. So hopefully Malaysia will continue to be part of the China +1 policy in the future. Yeah.
Shifting the gear to Asia Pacific, we know what happened in 2022, and most of investors are now more into the what next. Patrick, what are the key indicators to look at before we could expect a concrete recovery and rebound in Asia, particularly in China?
Yes, good question. So when we think about China, as you know, is the largest economy in Asia. Two major overhangs that I'm looking out for today. Number one, zero COVID policy. Number two, policy overhang from the property market. So what has happened this year itself is that the government continues to be very, very restrictive on the zero COVID policy, right? Meaning to say movements are being controlled, consumption is being curtailed, and so forth. And so what we've heard over the last 1 month is that a relaxation on this front, right? The number of days that you go into China today has been reduced from 10 days to now 8 days. Hong Kong has reopened. These are suggestions that basically China is starting to have what we call a dynamic zero COVID policy, meaning to say they're trying to ease the movements, they're trying to get the economy back to it. So I'm looking out for that, more and more of these kind of measures being announced, and I'm hopeful by doing that, the economy should rebound. Second big policy out there is on the property sector. The property sector obviously has a big overhang over the last year or so. I think liquidity is being injected into that as we speak, and I think that will ease in terms of the ability for consumers out there to buy property, and also to ease some of the developers out there in terms of their balance sheet and the liquidity issues. So I think based on these two fronts, these are two major things I'm looking out for. That will translate to obviously improvements in terms of the PMI numbers going forward, and we're hopeful that this will be a landing whereby the economy will start to rebound in 2023.
Okay, thank you, Patrick. So my next question is to Chun Hong. Southeast Asia has been an outlier position in 2022. Do you foresee this trend to continue for 2023?
Thanks, Azita. Thanks for the question. So I'm surprised that Patrick didn't touch on Southeast Asia when you talk about Asia. So you're right, Southeast Asia has been an outlier this year, especially they've been under the radar for the longest time. And to put things in perspective on numbers, MSCI ASEAN has outperformed MSCI Asia ex Japan by close to 20% year to date and close to 10% against the MSCI World. So yes, but this is not a surprise because generally ASEAN outperformed during a volatile period, and 2022 is one of the most volatile period that I've ever seen historically. So based on statistics, yes, ASEAN generally the place to hide during this period. But nonetheless, ASEAN has outperformed in 2022. So potentially flow might rotate back to some of the laggards, North Asia, notably China, as mentioned by Patrick, the two policy. As we move on from zero COVID policy and the slowdown in property outlook in China, potentially the flow will flow to China, being the largest market. But nonetheless, ASEAN is still the place to be in the longest term because we have a lot of things to offer. We have young demographic, we have respectable growth for the next few years, and also we have one of the highest dividend yield in the region and also compared to the MSCI World. So yes, ASEAN is the place to be in the long term, and it's still one of my favorite asset classes. Yeah.
Thank you, Chun Hong.
Not to mention foreign direct investments.
Yes.
Which is going to be very, very strong for Southeast Asia going forward.
Okay. So before we wrap up today's session, I believe in the mind of many investors, you want to know what is the direction for 2023. What is the best advice for clients in terms of asset allocation in the near term? And for this, let's hear from Patrick first, what we can expect, and then to be followed by Jesse.
Yeah, we've been saying this for a while, and we're going to reiterate the same asset allocation strategy, right? Our view is that there's still clients who still think about a bias towards equities versus fixed income. But having said that, this gentleman down here who manages fixed income basically has a very, very good asset class still. I still think that clients who want yield will need to continue to think about yield. I think there's never a better opportunity in buying fixed income products or money market products out there. But I do believe at the end of the day, timing the market is really, really not going to be conducive for you over the long term. I think timing the market is very, very important, meaning to say that you need to have a global diversified portfolio. We are a global fund manager. We can give you lots of other products out there. And I think you need to think about that when you think about your asset allocation strategy.
Okay, Jesse?
So I think for fixed income, we have not seen a year where global aggregate or US has been down for so much. So I think a lot of the rate hikes have been priced into the market already, and actually it provides the fixed income market with a much more stronger position as compared to the previous year in 2021. Yields are higher, duration is not exceptionally higher. So in that sense, I think the risk reward for fixed income has improved in that sense. If, let's say, next year we are coming to a more stable monetary policy environment, then I think fixed income will continue to perform, will probably perform very well over in developed markets. Again, largely because prices has corrected. In Malaysia, I would say that we are also, of course, the central bank needs to be very cognizant of the environment, and they will adjust their policy as and when they see the market data is coming in. But I would also look at where we are in terms of policy rate. We are probably going to be towards closer to the upper end of the policy cycle already. And if we are at that level, the Malaysian market would also look very attractive. I think it would perform fairly well. And, bonds would continue to be a key component in any portfolio. And I would say, yeah, it's good to have them.
Okay. Thank you, Patrick, Jesse, and Chun Hong. And to the viewers out there, we hope you've had insightful and valuable information To reiterate, the key takeaways from this session is not to time yourself in the market, but make sure you have time in the market to stay invested and stay diversified. Thank you very much for joining us and wishing you a great new year in 2023.